Good morning, traders. This is your Forex market commentary brought to you by ECN. Way dramatic sell-off in the euro seen over last week's trading session as markets sentiment shifted. This week will be packed full of market moving report by which we will touch base on and discuss how it can affect the euro moving forward. If you're trading the euro-dollar pair, I hope that this commentary can prove to be insightful. First in line with this discussion, we have the euro-dollar pair on the hourly time interval. A long-term bearish outlook has been set on the euro as market sentiment shifted on the weak fundamental structure of the euro. A false breakout above the 200-day simple moving average set the euro on descending channel for the last remaining two trading sessions of last week. This week is packed full of market moving report coming out from both the Eurozone as well as the US, while the expectation of a more dovish ECB has set the underlying tone for the euro into this week's trading session. Since the euro set a top at the 1.3900 zone, the euro-dollar cross had been undergoing a volatile period of consolidation. According to the SSI, which is also known as the Speculative Sentiment Index, net retail traders' short positions on the euro against the greenback have leveled off significantly. Currently, they are sitting at 3 outstanding short positions for every 1 long euro position. From a long-term technical standpoint, analysts are suggesting that the euro-dollar pair may be trapped trading within a consolidation range for some time as a full-on risk aversion is not a factor in the marketplace for a follow-through in this euro sell-off. Nevertheless, this bearish outlook on the euro has largely remained intact if the pair price action continued to trade below the critical high at 1.38 level. This week, ECB rhetorical will set the underlying market sentiment on the short to medium term euro outlook. In the case of the euro-dollar price action break below the 1.3702 support level, the next target is 1.3650 zone. Long-term bearish market sentiment cannot materialize until the euro take out the 1.3500 solid support level. Analysis of a collection of technical indicators on the hourly time interval on the euro-dollar market suggests a temporary bullish market sentiment and recommend long position on the euro. So here we have the hourly time interval, and overall we have a technical indicator recommending 5 buys, 2 sell, 3 neutral, with overall technical consensus of a buy on the euro-dollar. The hourly chart showed that the single currency opened today's Sydney trading session midway between its established midterm resistance at 1.3800 level, while the solid support is set at 1.3702. The euro-dollar pair continued to trade below the 200-day simple moving average. This trend holds great significance as the 200-day simple moving average contains more or less 1 year's worth of trading data, and it forecasts long-term market sentiment, and the pairs are trading below that, which is indicative of long-term bearish market sentiment outlook on the cross moving forward. However, this bearish view is also validated on the short-term moving average front as the euro-dollar pair opened today's Sydney trading session below the 5, 10, 20 and 30-day simple moving average. Collectively, this is indicative of a sell recommendation on the technical front. Touching base on this week risk events, on Monday we have the Eurozone core CPI year-on-year expected to tick at 0.8%, while the Eurozone CPI year-on-year is expected to tick at 0.6%. CPI number is also very important in the Eurozone monitoring its monetary policy because it's part of its forward guidance mandate. Also in the United States, we have Fed Chairman Janet Yellen. She will speak to the press. Over in Asia, we have the Chinese manufacturing PMI number forecast to tick at 50.3, while the HSBC manufacturing is forecast at 48.1. PMI number below 50 is indicative of a contraction. So this is very important as the market is monitoring the development in the Chinese economy to see if this contagion or slowdown in China can spread through the overall emerging market. On Tuesday in Europe, we have the German manufacturing PMI number forecast to expand at 51.9. Remember, Germany is the biggest economy in the Eurozone. Therefore, its PMI number play a big significance in the overall health of the Eurozone economy. As well as we have the Eurozone manufacturing PMI expected to take at 53.8. Over in the United States, we have the US ISM manufacturing PMI expected to show a reading of 54. On Wednesday, we have the Eurozone GDP quarter-on-quarter forecast at 0.3%, while GDP year-on-year forecast at 0.5%. Over in the United States, we have the US ADP, which is the private sector non-farm payroll report, expected to add 193K. On Thursday, we have the Eurozone interest rate decision, expected to stay at 0.25% for the Eurozone benchmark rate, while we have the ECB press conference, and the market are paying close attention to the ECB rhetorical. Also in the United States, we have the ISM non-manufacturing, which is the service sector PMI, expected to take at 53.5. Lastly, the wildcard for this week trading session is the Friday US non-farm payroll, expected to add 200K in terms of jobs, and the US unemployment rate is expected to stay at 6.6%. So now it's time to touch base on the fundamental front on the euro-dollar market. It is important to establish whether last week's euro sell-off against the greenback was largely attributed to a broader risk-off trade sentiment or just a shift in monetary policy outlook. The conviction behind these fundamental factors will prove and provide the market with a follow-through momentum. It is common knowledge that the euro-dollar pair are highly correlated to risk appetite, and the best way to monitor this market risk appetite is to consider the leverage level in the marketplace as well as the market's exposure to riskier asset investment. If these components unwind, then the condition tend to foresee the first cycle of risk aversion. Risk events surrounding release of leading economic report or policy meeting often can act as the catalyst for a shift in market sentiment. This week will prove to be a volatile week for the euro-dollar cross on numerous highly anticipated reports will be released this week. According to the VIX index, which is often used as a gauge for fear in the marketplace, it has been relatively low. What this implies is that the main mover for the euro-dollar price action will be more influenced by relative monetary policy between the ECB and the Fed. The market has already priced in expectation for a US benchmark rate hike by mid-2015 as hinted by Janet Yellen during the previous FOMC meeting. However, on the more dovish spectrum on monetary policy, the ECB are expected to pursue a more easing policy as deflation has become more of a prevailing concern in the Eurozone. Both the World Bank and the IMF support this ECB dovish view, expecting the ECB to further cut their main refinancing rate or even as aggressive as pursue a negative interest rate. Since last week, numerous ECB policy makers has voiced their concern over the strength of the exchange rate of the euro and attempt to talk down the single currency, linking deflation as a risk for further easing policy. During the March ECB meeting, the market perceived the ECB rhetorical to be hawkish as leading economic report appeared to show signs of improving while peripheral Eurozone bond yields are at record low across the board from Spain to Greece. However, excessive liquidity have leveled off to and fall to pre-LTRO level at 10 billion euro. The concern is that the Eurozone interbank lending rate can come under pressure, which could escalate to provoke the ECB to step in to become more accommodative. According to the EONIA, which is the interbank lending rate, have jumped 20 basis points from 0.157 last month to 0.174%. I want to thank all our listeners for listening and have a successful trade.